Hello all, welcome to Get Into IAS, and in this video we are going to continue with the chapter Indian Financial System on Capital Market. Let's move into the topic. So what is called as free float market? So the example like the value of traded shares, as told already is calculated with the help of price of one share. Say price of one share is 200 rupees into the number of shares traded, that is 2000 shares has been traded. So when you multiply this, you'll get 4 lakh. So this is called as the value of the traded shares. That is called as what? This 4 lakh rupees is called as free float market. Fine. Now moving to market capitalization. Fine. What is called as market capitalization? So the value of traded plus non-traded shares are called as market capitalization. So normally all the shares, whether if it is traded or non-traded, that is called as market capitalization. See, the value of all, both traded and non-traded. Non-traded is the shares that are kept for a very long time. It's called as market capitalization. And now coming to the formula for market capitalization, it is price into total outstanding share. For example, the same way, say take 200 into 2000, the price of one share into total outstanding shares, that is traded plus non-traded shares, is equal to 4 lakh. This is called as what? Market capitalization of free float market. Fine. Next, moving to the depositories. What is depositories? The institutions that keep securities of investors in electronic format is called as what? Depositories. See, normally I am going and depositing my money inside a bank account. But, so I am using various instruments like Google Pay, Phone Pay. So all these are electronic modes of transaction. With this, I transact my amount, I find my balance. So all this I do with the help of electronic mode. So all the data are saved in electronic format, that is called as demat account or dematerialized account, which is not in paper format but in electronic format. So these are called as depositories. Okay. So I'll repeat. See, demat stands for dematerialized. It means securities that were kept in paper material format now made into dematerialized electronic one. Earlier it was in paper format. Now it is in electronic format. So this electronic format is stored and maintained by these depositories. So these institutions maintain all the information in the demat account. Fine. So the change in ownership whenever transfer of securities take place. See, when security is transferred from person 1 to person 2, all this is being recorded in the demat account. And in India, there are 2 depositories. Fine. So in India, how much depositories are there? 2. One is National Securities Depository Limited, NSDL, and the next one is, which is located in Mumbai, and the next one is the Central Depository Services Limited in Mumbai. Okay, both are located in Mumbai. One is national, another one is central. So the National Securities Depository Limited is the first depository in the country. So among these two, the national and the central, first one is the National Securities Depository Limited. So it was established by UTI, Unit Trust of India, NSE and IDBI. So the Central Depository Services India Limited, CDSL, was established by Bombay Stock Exchange, Bank of India, Bank of Baroda, SBI and HDFC Bank. Fine. So you have to know who all established these corporations. Next, moving to clearing houses. So what is called as clearing houses? So clearing houses enable easy settlement of securities trade. Fine. So there will be easy settlement. See, person 1, person 2. These both people will have a trade. So this trade is through securities. So there will be an easy transaction from person 1 to person 2. That is done with the help of the clearing houses. Fine. So like depositories, it also helps in change of ownership and delivery of securities. Same way how the depositories is doing all the things, same way the clearing house also will do. That is the delivery of securities and the change of ownership is done through clearing houses. Next, moving to clearing banks. Clearing banks mediate fund transfer between buyers and sellers. Same way, between the buyers who are all buying and who are all selling. So the fund transfer will be very smooth. Fine. So both securities and fund transfer are made through National Securities Clearing Corporation of India. So we already saw about that, NSCCL. So it mediates between various depositories, clearing houses. So between these depositories and clearing houses itself, this clearing banks will mediate. Fine. See, in case if person 1 has an account in these depositories and person 2 has approached clearing houses, this clearing banks will mediate between the depositories and the clearing houses. Fine. So, these are called as what? Clearing banks. Next, moving to rolling settlement. Fine. So, what is a rolling settlement? Trade in securities market is settled in few working days. Very important. See, the trade between person 1 and person 2 takes place within few days. That is called as what? Rolling settlement. Normally, this few working days tend to be 2T. 2T means 2 working trading days. Fine. 2T means T denotes trade days and 2 denotes number of working days. Fine. So, within these 2 days, it will be cleared. That is called as trade in securities market is settled in few working days. That is called as rolling settlement. Fine. Okay. So, the fund transfer that is happening on that day. See, at the end of this second day, there will be 2 days, right? Day 1 and day 2. At the end of this day, the fund will be transferred from person 1 to person 2. That is called as the settlement day. Fine. Next, moving to the online trading. Online trading is very easy. If all the trading instead of person to person, if it is made online, it is called as what? Online trading. For Bombay Stock Exchange, the online trading is called as Bolt, and for National Stock Exchange, the online trading is called as NEET. Fine. So, next moving to the development financial institutions. So, these institutions lend long-term funds or long-term loans, that is more than 25 years. More than 25 years, if you borrow from someone, that is called as development financial institution. Those development financial institutions only lend that amount, specific amount. For example, take Exim Bank, Export Import Bank. This bank is normally for the people who do exports and imports, who are into the process of exporting and importing products or services, right? So, when these people demand amount, money or loan from the market, they get it from the development financial institutions. Fine. Okay. Next, moving to the financial intermediaries. So, who are called as financial intermediaries? So, under this, the capital market. We already dealt with the capital market, right? So, under the capital market, we have the stock exchanges, right? And the development financial institutions. So, except the stock exchange and the development financial institutions, all other institutions are called as financial intermediaries. For example, take RBI. RBI regulated financial intermediaries, SEBI regulated financial intermediaries, National Housing Bank regulated intermediaries, Department of Company Affairs regulated. So, all these are called as financial intermediaries. Fine. So, we will see the RBI regulated NBFCs. So, we saw the financial institutions under the capital market is termed as NBFCs. So, those NBFCs that are regulated by RBI, what are those NBFCs? So, we have the equipment leasing company, hire purchase company, loan company and the last investment company. So, these are all the NBFCs regulated by RBI. See, for example, take the first one, equipment leasing companies. What are these NBFCs? First thing, equipment leasing companies own machineries and equipments and lease them to clients. Leasing is like, see, if in case this company has a tractor, okay, there is a farmer here, he will lease this tractor. For how many days? For days or months? Take 2 months, okay. For this, he will pay to the equipment leasing company. Fine. So, these are a kind of NBFC regulated by RBI. Okay. So, in return, the equipment leasing companies get rental income. So, monthly or weekly, they'll get income from the farmers. Fine. So, these are regulated by whom? By RBI. Next, moving to hire purchase companies. Hire purchase companies refers to purchasing equipment, machinery, etc. in installment payment system. Very important. See, for this, the farmer is paying rent. Okay. But in a hire purchasing company, same way, he will lend the equipment to the respective farmer, but the farmer has to pay in installments. Take 10,000 rupees. He is telling, he is demanding 10,000. This 10,000 will be divided into 2 or 3 installments and the farmer has to pay respectively. That is called as hire purchase companies. Fine. And hire purchase companies finance this kind of purchase and recover money from the clients in installments. So, normally when these people get in installments, it is called as hire purchase. When they get in rent format, it is called as equipment leasing. Fine. Next, however, with effect from December 6, 2006, the above NBFC registered with RBI has been reclassified. So, this hire purchase company has been reclassified into asset financing company, loan company and investment company. So, this has been reclassified by RBI into 3 other formats. We will deal with that. First one is the asset financing company or asset finance company. The RBI website defines asset finance company as asset finance company would be defined as a company which is a financial institution carrying on as its principal business the financing of physical assets supporting productive economic activities such as automobiles, tractors, lathe machines, generator sets, earth moving and material handling equipment moving on own power and general purpose industrial machines. So what this asset finance company is doing is, see, normally I am a farmer, I am willing to get a huge machine. Not only a farmer, maybe an industrialist, okay. So he is planning to get a huge machine. So for that, this NBFC is lending loans. Fine. That is called as asset finance company. I hope you got the point. Next, coming to loan company, it is as normal as a bank. See, the main business of the loan company is lending. They do the lending activity. So they provide what? Car loans, mortgage loans, gold loans is provided by this loan company. So gold loan in the sense, if I give loan to him for this value of gold, he will give me money. That is called as gold loans and that is called as a loan company. Next, moving to the last one, the investment company. So under this investment company are the companies which invest in shares to acquire stake in other companies to earn profit and not for the purpose of trading. Very important, see. Investment companies. This company is not going to do any activity. It is not going to do lending or it is not going to take deposits. What this company will do is, there will be a large, bigger company. This company will issue shares. What this investment company will do, it will go purchase these shares and it will get profits from that share. So these are called as what? Investment companies. Fine. So the main purpose of the investment company is that it will go get shares from a larger company. Fine. Next one is the SEBI regulated NBFC. Now we have done with RBI regulated NBFCs. Now moving to SEBI regulated NBFCs. So what are the SEBI regulated NBFCs? The venture capital funds, the merchant banking companies, the stock broking companies are called as SEBI regulated NBFCs. So now next moving to the SEBI regulated NBFCs. The first one is the venture capital fund. What is called as a venture capital fund? See, usually the financial institutions are hesitant to finance new products because of the profitability of new products is uncertain and involves risk. See, for example, if I am releasing a new edition of the old book, that book will run because already the old book has so much profitability. In case, if in the market I am releasing a totally new concept of book or take it to be any kind of a product that is very new to the market, so normally there tends to be a less profitability. That is, the people will think whether for this product we will receive profit or not. Fine. So in that case, what will happen is, so to finance such products, separate type of financial companies who venture to finance them are established. So here comes the venture capitalist or the venture capital fund. So there are separate companies called the venture capital companies or the venture capital funds which will provide fund to the new product, who are establishing the new product. Fine. For the innovative purposes, if these venture capitalists think that this product is innovative and it will earn profitability, they will invest in that new product. That is called as what? Venture capital fund. Fine. So they are called venture capital companies. The venture capital companies provide capital to companies that produce new products based on innovation and to new industries. So to new products they fund from the venture capitalists and to new industries also they keep funding. So this is called as venture capital fund. Please keep this in mind, very important for both prelims and mains. Now moving to the second one, merchant banker. Fine. So under merchant banker, merchant bankers manage and underwrite new issues, provide consultancy and corporate advisory services for corporate clients on raising funds and other financial aspects. See, I'll tell one of the aspects. If I have a doubt in the financial market, I approach this merchant banker for advice. So what this merchant banker will do, he will advise me whether to get the securities or not. So based on his advice, I will take my decisions. So that is the work of what? Merchant banker. Fine. Now, in India, merchant banking services are carried out by commercial banks. So in India, who are the merchant bankers? The commercial banks in India are the merchant bankers. The merchant banks are also called as investment companies. So because they invest their time and money in the market, that's why they are called as investment companies. Now, merchant banker has been defined under the SEBI. Rules 1992, as any person who is engaged in the business of issue management either by making arrangements regarding selling, buying or subscribing to securities as manager. So normally they will tell the person who is approaching them whether to sell or buy the securities, or whether it will be profitable or whether it will go in loss. Fine. Consultant, advisory opinions or rendering corporate advisory services in relation to issue management. So normally they are managing all the corporates. Normally these corporates will approach the merchant banker for advice. So this merchant banker is defined under SEBI. Fine. Moving to the third one, stockbroking companies. We already dealt with the companies. So normally there will be a buyer and the seller. They will help the investors to buy or sell the securities and they will charge an amount for that. That is called as stockbroking companies. Okay, we already dealt with this. Next, moving to the National Housing Banks, regulated NBFCs. Fine. So normally these NBFCs are used for the construction purposes. They are maintained by, regulated by National Housing Banks. Fine. See over here, housing loan companies are regulated by National Housing Bank. Housing loan companies finance construction and purchase of a house. So in case if you are constructing a house or purchasing a constructed house, so these NBFCs will fund you, and that is regulated by whom? National Housing Banks. So next, moving to Department of Company Affairs, regulated NBFC. So the Nidhi companies are regulated by Department of Company Affairs. Very important for prelims. Nidhi company is regulated by whom? Department of Company Affairs. Fine. Nidhi companies accept deposits and lend to its members. So what are the two words? It accepts deposits and lend to the customers. Fine. So these companies are not regulated exclusively by the Department of Company Affairs. Why? They are regulated by RBI also. So this also is very important for prelims. See, these Nidhi companies are regulated by Department of Company Affairs as well as RBI. Fine. Keep this in mind. Very important for prelims. Fine. Only the administrative matters are controlled by it, and deposit and lending norms are regulated by RBI. See, this DCA takes care of the administrative matters of Nidhi companies, and the deposits and lending activities are taken care by RBI. So that's why these two are the regulators of what? Nidhi companies. So now Nidhi companies therefore have two regulators. So the Department of Company Affairs and the RBI. Next, moving to the related terms in this lesson. First one is the face value and issue price. So what is face value? For example, face value is the actual value of shares. Issue price refers to the price of a share including share premium. For example, see, face value is the actual value. In case the value of the share is ₹10, that is called as the face value. What is called as issue price then? Issue price is face value plus the premium amount. Face value of this share is 10 rupees and the premium amount is 690 rupees. So the total value of this share becomes 700 rupees. This is called as issue price. The price I am really paying and getting the share is called as issue price. See here, for example, the face value of a share may be 10, but due to high demand, the share can be issued at 700 rupees. Only the 10 rupees is the value of the share. But now the value of the share is how much? 700 rupees. Here the share premium is 690. I already told you all. Now the increased amount of the share premium is 690. Fine. Now the thing to be noted is that the companies announce dividend only on the face value. Very important. In this case, if a company says the dividend is 23%, it means 23% of 10 rupees. See, what is dividend? Dividend is nothing but, in case if I am investing 10 rupees, for this 10 rupees the profit is 5 rupees. And if this 10 rupees has two investors, person 1 and person 2, fine. So each 5 rupees has invested a total amount of 10 rupees and the profit they earned is 5 rupees. So this 5 rupees is again divided into 2.5 rupees, 2.5 rupees and shared between person 1 and person 2 along with the 5 rupees of the early share. This is called as dividend. So the profit is divided into the number of shares, that is called as dividend. So in the issue price, the dividend rate is not on the total of 700. It is on the total of the actual value. See, 23% of the dividend means 23% of 10 rupees only, not 23% of 700. So this is how the face value and issue price is derived. I hope you got the point. Next, short selling. What is called as short selling? In short selling, the seller sells the securities without owing the securities. He borrows the securities and sells it. See, there is person 1, person 2 and person 3. This person 2 doesn't own any security. What he is doing inside, he is approaching person 1 to sell that security to person 3. By this, he gets a short amount of commission. So, this is called as short sell. Fine. Next, bull and bear trading. What is called as bull and bear trading? This is previous year UPSC question. Very important to be noted down. See, in bull trading, buyers buy more shares in the expectation that the securities price will rise in the future with a plan to sell at that time and earn profit. So, what is bull trading? See, I am a buyer of a share. What I am doing? A share costs rupees 10. So, I am thinking at an earlier rate, the price of the share will increase, say from 10 to 100 rupees. So, I am purchasing more amount of shares. Say, earlier I planned only to buy 2 shares. Now, I am planning to buy 5 shares. Okay, I am getting a lot of shares. Thinking that at the future rate, the shares of all these will increase at a faster growth. Fine. So, this is called as bull trading. Accumulating a lot of share is called as bull trading. Next, in bear trading, the seller sells the securities with the intention to avoid loss in the expectation that the security prices will fall. So, this is the opposite of bull trading. So, under the bear trading, what is happening is this seller, right, he gets scared of the fall in price of securities. So, see, he got the security at 10 rupees. He is getting scared that the price may fall to 5 rupees. So, he is tending to sell all the securities at a faster rate. That is called as, and there are a lot of buyers also to get this. So, he is selling his securities at a faster rate. This is called as what? Bear trading. I hope you got the point. Next is securitization. Securitization is the method of converting existing assets into securities. So, assets is turned into securities. Take the case of banks. Their unrecovered loans are considered as non-performing assets. We already dealt with non-performing assets. So, all the unreturned loans are taken as NPAs. These assets are sold to asset reconstruction company. So, the loans of the banks are the assets of the banks, right? It has to be repaid by the borrower, and hence what is happening? The banks are not getting the amount back from the borrower, and hence all these assets are sold to the asset reconstruction company, that is called as ARC. So, there is a company called as ARC, Asset Reconstruction Company. The banks will sell all the non-performing asset to the asset reconstruction company. What this company will do, they will buy all the NPAs and they will try to get all the NPAs from the borrowers. Fine. So, this is called as what? Securitization. So, the asset reconstruction company divides the total assets into equal parts and sells to investors. So, this is what is happening in securitization. Fine. Next one, what is buyback? So, buyback refers to the issuer buying the securities again to accumulate shares in his hand. So, what is happening in buyback? The issuer, see, there is person 1, he is the issuer. This issuer has sold his security to the person 2, that is the buyer. Now, what he is doing? He is getting back the security from him by paying him back. So, this is called as what? Buyback. I'll repeat. Buyback refers to the issuer buying the securities again to accumulate share in his hand. So, this is kind of a share, right? Security is kind of a share. That's why he's getting back the share back from the buyer. That is why it is called as buyback. What he gave, he's again buying it back. That's why it is called as buyback. Next is market capitalization GDP ratio. What is called as market capitalization GDP ratio? Under this, it is called as MCGDP. It is the ratio between total market capitalization of all stock exchanges and GDP of the country. See, under the stock exchanges, we have NSE and BSE, right? So, it is the ratio between the total market capitalization. Ratio between the total, we already dealt with market capitalization. What is market capitalization, right? The 4 lakh example I gave you all, right? It is the value of the, or the ratio of the total market capitalization of all stock exchanges and the GDP of the country. So, GDP of the country is taken into account and the market capitalization is taken into account. The ratio between these two is called as what? Market capitalization GDP ratio. Next is price earnings ratio. What is called as price earnings ratio? Under this, the price earning ratio is the ratio between price of the share and earning. dividend income profit per share. For example, take what is price earning ratio. It is the ratio between price per share. See, price of per share is 10 rupees. And then the earning is the ratio of that. See, earning is 10 plus how much rupees? 3 more rupees is the profit. So, divided by 13 is the price earning ratio. The price of the share plus the earning totally you got at the end of the maturity date is called as the what? Price earning ratio. Next, coming to net asset value. Net asset value is the net value of outstanding shares. So, how much ever shares you are holding in your hand, that is called as net asset value. Share is an asset for you, right? So, that is called as what? Net asset value. Net asset value is the total asset value minus liabilities of the mutual fund. Total asset value is the total number of shares as per price share in the market. We already dealt with this. See, net value. They are telling net value is the total asset value. What is net value? It is the total asset value, how much ever total asset you're having minus the liabilities of the mutual fund. So, mutual fund, we'll deal with mutual fund later, but keep in mind, mutual fund also have certain amount of money. They have borrowed certain amount of money. They should give back the money to the shareholders. So, if you minus the total asset value from the mutual fund liabilities, that is called as what? Net value. Total asset value means it is the total number of shares and price per share in the market. So, we have already dealt with it. Total share will be 20 into price of that will be 10 rupees. So, that is called as what? Total asset value. Next, coming to high net worth individuals. We already dealt with this. See, high net worth individuals are those who have net financial asset of at least $1 million and those who have net worth of at least $30 million financial asset. So, whoever are having $1 million and $30 million, okay, these people come under the high net worth individuals, fine. So, they are called as ultra high net worth individuals. So, who are not have the net worth of more than $30 million, they are called as ultra high net worth individuals. Next, transferable and non-transferable. We already dealt with this. See, transferable means securities are of two types. One is transferable, another is non-transferable. The term non-transferable means you can't transfer it to anyone. It's often seen in our day-to-day life. See, in bus tickets and train tickets, we can see the words non-transferable. Means that we cannot sell it to other people, right? To put in another way, we cannot change the ownership of these tickets. See, if in case you are purchasing a bus ticket or a train ticket, you can't sell it to some other person. Same way air tickets also. So, that is non-transferable. The ownership remains with the same person, right? Likewise, in the case of securities, if it is transferable, we can change the ownership, and in case of non-transferable securities, the ownership cannot be changed. Next, coming to the cumulative and the non-cumulative shares. Cumulative shares are shares that are entitled to receive dividends of a particular year in the coming years as arrears if the company had not given dividend in the particular year. Cumulative means consolidating the arrears of the past year. Keep it like this. See, if there is a company A, this company A has 3 shareholders, shareholder 1, 2 and 3. What this company should be doing, the previous year 2020, it should have paid ₹100 to each person as what? As the dividend, fine, but it hasn't paid them and hence it will pay these shareholders on 2021, it takes any month, okay, they will be paying the arrears on the next year. This is called as what? Cumulative shares. Non-cumulative is the opposite of that. You can't accumulate the arrears and pay it for the next year, fine. Next, convertible, non-convertible securities. See, convertible means one kind of securities can be converted into another kind of securities. For example, you can change from bond to share. So, a bond can be changed to a share. This is called as convertible security. And in case of non-convertible securities, you can't change it from a bond to a share. Fine. Next one is the mutual funds. Very important fund, mutual fund. Previously asked in UPSC preliminary examination. So, mutual fund is nothing but, see, while merchant banker primarily help issuers, the mutual funds help investors. So, who are getting benefited from the mutual funds? The investors. Fine. The mutual funds mobilize the savings of the people and invest in securities. See how the mutual funds is. Same way. There will be person 1, person 2, person 3. It will collect from all these people, and these people, the mutual fund holders, right? these people knows in what security to invest. So with the help of the knowledge, they get the money from someone, but they invest in another security. So this is called as the mutual funds. I'll explain. See, the individual lacks expertise in stock market and have very small amount to invest. So in case if I like to invest in a mutual fund, but I don't have the knowledge expertise for that and I have very little amount of money in my hand. So what I'll do, I'll go approach these mutual funds. So the mutual funds collect money from the public and create a large pool of money, and with their expertise, they invest in securities. So these mutual fund investors, that is the middlemen, have a lot of expertise and knowledge. What they will do, they will collect small amount from various kinds of investors and pool into a bigger amount and invest that in a security. So that's why they are called as mutual funds, right? So they invest in product called units. So these mutual funds, right, they invest in a security that is called as what? Units. So they invest in product called units. Units are made up of more number of securities. So with this amount, they invest in various kind of securities. They get the amount from the public and they invest in various kinds of securities called as units. Fine. Now moving to the hedge funds. So hedge funds is also very important for prelims. So it is the same as mutual funds, but the money won't be borrowed from the public. See, hedge funds are similar to mutual funds, but in the case of mutual funds, it is collected from the public and invested by mutual fund, which is created by somebody elsewhere. In case of hedge funds, it is not public but a handful of investors who join together and form funds of their own and invest in different securities and use different investment strategies. So people who are very rich, right, they will come together and they will club in a lot of amount and invest in various kind of security. But in mutual funds, it was not like that. In mutual funds, the money was got from the public. Over here, huge investors come together and invest money in various securities. Fine. So these investors are sophisticated and financially well. So they do not need protection from SEBI and they are unregistered and unregulated. See, this a small amount of money is not a big deal for them, and hence there is no need of protection for them. And that is why they are unregistered. Hedge funds are unregistered and unregulated. Very important point. See, mutual funds are registered and regulated, but hedge funds are not registered and they are not regulated. Fine. Next, going to the offer for sale, OFS. So offer for sale is also like FPO. FPO is collection of additional funds, right? Opposite to initial public offering, IPO. So while the FPO was to raise additional fund requirement, the offer for sale is to dilute the shareholding of promoters in a listed company. In offer for sale, they are diluting the shares. Okay, they are not pooling in a lot of money or they don't want more amount of shares. They are diluting the shares. See, for example, as per Securities Contract Regulation Rules 157, at least 25% of all types of securities issued by a listed company should be in the hands of the public. So what is it is? See, normally they are telling, so if in case, if this is the stock exchange, keep it to be BSE or NSE, fine. So in this, if there is a listed company, say company A, fine. So under this, if this company has a lot of shares, it should dilute some amount of shares and give 25% of shares to the public. Okay. So dilution should be done. That is called as offer for sale. See here, to meet this requirement, the company approached public to sell their shares through OFS. So, to bring in the public into the share market, what these people are doing, they are diluting their own shares. Coming to a note on commodity exchange. So, a note on commodity exchange, the last topic of this lesson. See, the commodity exchange is a platform to buy and sell agricultural product. So, what is a commodity exchange? There will be a platform. In that commodity exchange, you can buy and sell agricultural products, natural resources like iron ore, crude oil and precious metals like gold and silver. So there are many regional exchanges and 6 national exchanges. Fine. National level you have 6 exchanges and regional level you have a lot of that. You have a lot of exchanges. So they are multi-commodity exchanges, MCX, National Commodity and Derivative Exchanges, NCDEX, National Multi-Commodity Exchange and Indian Commodity Exchange, the ACE Derivative Exchange and the Universal Commodity Exchange. The apex body for these exchanges was Forward Markets Commission. So for all these exchanges, the top body, apex body was FMC, Forward Markets Commission. Now it is merged with SEBI. So this FMC, Forward Markets Commission, is merged with SEBI. Fine. So there is no separate market like that. It is merged with SEBI. So the commodity exchange is more akin to stock exchange. They're telling this commodity exchange, right? It is similar to the stock exchanges. So how we are listing various companies in stock exchanges, same way commodities are also listed in the commodity exchanges. Fine. The concepts used in stock exchange and commodity exchange are the same. So the concepts are very similar. For example, derivatives trading exists in both the exchanges, or we already dealt with derivatives. So in both the exchanges, it carries the same meaning. So normally they're telling the commodity exchanges and the stock exchanges are more or less the same. And with this, we come to the end of this lesson. That is Indian financial system, capital market. Thanks for watching, and please subscribe to get into IAS and follow our Telegram link in the description box given below. Thank you.